Hello and welcome to the Bam Cam podcast with your hosts, Jack Burnette and Alison Castellano. And we have Adrian Castellano as well. We have a full house today, guys. I am Wendy McConnell. Thank you for being here. Guys, how we doing?
Good.
Fantastic.
We have the whole team in today.
I see that.
You can barely fit 3 chairs in here.
It's a good thing we like each other because it is quite cozy.
Well, your family. So I hope, that's very convenient that you like each other. Jack just got back from yet another vacation.
Yes. Barbara and I spent a couple of weeks in Colorado, and it was lovely. Went to a dude ranch and rode horses and spent a week there, and then went to Aspen and celebrated our 41st anniversary and my wife's something number birthday. and anyway, suffice it to say, we celebrated her joining the ranks of Medicare. So,
she might not like that you put that out there.
But the highlight in Aspen is on our anniversary, we did a hot air balloon ride.
Nice. Very nice. Now, I think I would be scared, but you weren't.
I was not, and I typically do not like heights very much, but it didn't bother me. It was actually a wonderful experience. So a lot of fun. It's something that's been on Barbara's bucket list for years. So I
finally said yes.
I finally acquiesced, and we got actually postponed several days due to weather and other factors. So, but we had the right day, and it came up, and we did it. So it was fun.
Very nice. Very nice. So what are we going to be talking about today, gang?
Well, today we're kind of, following up with our early podcasting days. We talked a little bit about life insurance, and today we're going to do a deep dive on life insurance.
And by the way, I did have my life insurance premiums paid before I went on the hot air balloon ride.
Just in case.
For Barbara and for me. So.
Yeah. Yeah, so we're throwing it back to those adulting days, and life insurance is something that you hear about your whole life, and you hope you never need it, but it's always better to be prepared than to be surprised. So, Dad, can you just tell us, in your own words, what is life insurance?
Well, life insurance basically is protection to pay you if you can no longer fog a mirror. So you pay someone that you designate. So if you die, and particularly it's important for, I think, young families such as yours with children and with a lot of earnings potential ahead of you in life, you want to protect that stream of earnings should it be cut short unexpectedly.
Your working years.
Yeah. So you want to protect that stream of revenue that you have to deliver to your family. So you do that through life insurance. And there's several different kinds of life insurance, but the primary reason for life insurance is to protect your family should you not be able to deliver on your earnings potential going forward.
Yeah.
So by definition, under those circumstances, young people with more career ahead of them probably need more death protection than someone my age, even though I do have life insurance. So I think it becomes very important for young people with families especially to have serious conversations about how much protection you need and what types of life insurance, because there's different types of life insurance, and some are more lucrative to the salesperson selling it than others. And they don't necessarily, the incentives don't align.
That's true. Well, my first experience with life insurance was when I first started working, when I got that first, real big girl job. And I learned that as part of my benefits or compensation package, I had think it was just 1 times my salary of coverage for life insurance that could go to a beneficiary. And, most people who are listening to this podcast probably have a similar type of coverage through their employer as part of their benefits package.
So 1 time salary or maybe 2 times salary. Mm-hmm. And if you have 30 more years to work, that's about 30 times underinsured.
Yeah. So let's talk about some key features of that employer-provided life insurance.
Yeah, one important aspect here is the group coverage. The life insurance policy is issued to the group of people, the employees, rather than just one individual at one time. And so that means that the policy terms, the coverage amounts, the premiums, they're all standardized across that group of employees. So they're all going to be eligible for the same benefits. One, that lowers the cost to insure because it is, again, like I mentioned, standardized rather than to the individual. And in many cases, you're not going to be paying extra for that basic package. It's included in your benefits package.
That's generally correct. And the only underwriting that's done is by gender, male and female, and smoker or non-smoker.
Yeah.
That's the only underwriting I've ever seen done. It doesn't matter if you're obese or if you have chronic illnesses such as diabetes or heart disease or anything. They don't go into any of that. So it's a way to be insurable sometimes when you may not be insurable.
It's a very good starting place.
It's not a bad starting place. But it's important also that you check your beneficiaries. Often when you started working,
I wasn't married.
You weren't married.
So my beneficiary was my brother.
Correct.
And when we got married, I had to go in and change that election. So that's something that people need to make sure that they do through the course of their career too.
So those of you listening out there, if you have employer benefit life insurance, go check the beneficiary because you may have set that beneficiary 15 years ago and never looked back. Yep. And just make sure it's appropriate.
Yes. So like we said, that employer-provided insurance, it has a basic level of coverage at no cost to the employee. It's usually a multiple of your salary. I've seen 1 times your salary, 1.5 times your salary. I've even seen 2 times your salary for some people, but that seems to be a really generous package.
Yeah. And I will tell you, for life insurance, also, you get a phantom income that you get taxed on for an amount, I believe it's above $50,000 of death benefit. That amount of that premium that's paid, even though the employer pays it, that's an imputed income that you pay income tax on. So it's reported on your W-2.
More tax fun.
Yes. So it is, life is complex.
Oh, yeah.
Yes. Yes.
So anyway, sometimes you can buy additional coverage as an option when you do your benefit elections, which are often in the fall for most employers. And if you buy more, you're buying it at that underwritten rate. If you're extremely healthy, you may be paying more than you would if you owned your own policy. Also, the rates for those policies go up. And once you cross age 50, if you're healthy, you can probably buy insurance on your own, much less expensive than what that group policy is, especially if you can get a standard or preferred or even super preferred rates.
Yeah.
Well, so an employer-provided group life insurance, like Jack just mentioned, it's convenient for some degree of protection, but the amount of coverage provided, it's probably not going to meet what you actually need. And so it's really important to sit down and figure out what kind of coverage you do need and your age and your circumstances. Buying an individual policy in addition to your company policy, it's a smart way to kind of give you that financial protection that you actually do need.
Like you said, that earning potential that you want to protect, you might have 30 years that you want to protect, and that your employee package is not going to protect 30 years.
Plus, if you change jobs it goes away.
It goes away. Yeah.
So then
That's
you go
something
to
we do well.
you go to another employer, and it becomes it becomes and then you're under the benefits of the new employer.
Mm-hmm.
So having your own policy in addition to that base coverage through the employer probably makes a lot of sense for most people.
Yeah. Now, there are several different types of life insurance out there. You hear kind of two terms most of the time: term life insurance, and then there's permanent life insurance. Can you kind of give a real quick rundown?
Yes. Term life insurance is exactly that. It is life insurance that's in effect for a period of time. It might be a 15-year term, a 20-year term, even a 30-year term. There are some carriers that will even go out past 30 years. But 30 is generally about the most. So if you do a 30-year term, you pay premiums over the course of the 30 years, and the premiums are level for that period of time, and it has a death benefit. So if it's a $1 million 30-year term for $100 a month, then you pay $100 a month, and as long as you pay that premium on a regular basis, on time, through that period of time, if you die anytime in the 30 years, then it will pay your beneficiary the $1 million.
That seems pretty simple to understand.
So the sooner you die, the better a deal it is.
We don't really want to die here.
Correct.
We're not giving that advice.
And often with term insurance, the idea is not that you're trying to get a good deal. You're trying to protect against the unexpected. Mm-hmm. And that is the purpose. It is not necessarily that you're wanting to cash in on this. So that is the purpose of term insurance. Very simple. You're either dead or not. You've either paid the premium or not. It's that simple. For other types of life insurance, you hear about cash value life insurance, permanent life insurance. Different types of those are whole life, universal life, indexed universal life. There's a few others. But what they are basically is a term policy with an investment wrapper involved. And it builds cash value inside that policy. It can offer some tax advantages for that, but it is much less bang for the buck on death protection for the amount of premium paid. So for that same $100 premium, you might not get $1 million policy. You might get a $40,000 policy or $50,000 policy. So it is far more expensive from a monthly cash flow perspective, or quarterly or annually, however you're going to pay the premiums. And typically, in my experience, permanent life insurance is designed more under certain circumstances where we're trying to achieve certain things to pass money to heirs tax-free, and it's got a strategy involved beyond just death protection.
Okay, interesting.
So particularly when you get into complex estate planning issues, permanent life insurance held in an irrevocable life insurance trust can be a good strategy. We're talking about net worths in excess of $10 million typically for that. So for the most part, in my experience, most people need term insurance. Now, we have had a number of cases where people have old cash value policies that they've had for years and years and years, and they may not be working very well anymore, or they're tired of making these premium payments on this low death benefit policy. And we can often take a look at those and maybe do a tax-free exchange and improve the situation. Older policies that were written 20 years ago, 30 years ago, 40 years ago, the assumptions that those policies were built around have changed, the economic assumptions. So often they can be exchanged. And so We're working on a case right now, and this happens to be for a family member of ours that had two policies that her father took out on her when she was a child, and a total of $25,000 death benefit, but she still was paying a premium of about $150 a year. And it just annoyed her to pay this premium for something that her father set up with a $25,000 death benefit. So in that case, she also has a large term policy that has a lower premium. So anyway, long story short, we're in the process of exchanging that for a policy that's going to be fully paid, no more premiums, and the death benefit's going to triple. So the death benefit triples, the premiums stop. That's a win.
That is a win.
So anyway, there's opportunities often with these old permanent policies. Yeah. And we've worked with a number of clients with these old policies that weren't very efficient and not the right types of insurance for people.
Yeah. So we can help you get the right kind of insurance for your needs. But Dad, when we were looking at getting insurance for ourselves, you said something that really just kind of stuck with me. And, you know, if one spouse were to die unexpectedly, there would certainly be emotional trauma, there would be hardship, but insurance can help alleviate that financial trauma. And I know, like, if I were to go unexpectedly,
I'll say that.
I hope I don't, but you would, you know, want to kind of wipe the slate clean financially so that you and Laura could be taken care of. And I would hope that for you.
It would be one less big stress to deal with in a whole multitude of stresses that would be going on.
Right.
Mm-hmm. So that's kind of what led us to pursue getting our own life insurance policy that's outside of an employer policy.
Exactly. So we have an almost 2-year-old. We talk about her, obviously, every episode. So this is our chance to kind of fit her in. Laura's almost 2. And we knew that if something happened, like Alison mentioned, to one of us, that loss of income would just be devastating. We could not.
You couldn't stay to live in our house.
Live with just one salary. And so that's why, obviously, we went ahead and pursued life insurance coverage. We actually purchased term policies on both of us. And so that's going to get us through our working years. And then by the time we get through our working years, the hope is with an adult child at that point, we've paid off our house. And so then the financial burden wouldn't be as daunting. And then we can reassess our insurance needs and make a plan then for the future there.
Yeah.
Right. Because you can still buy life insurance even at older.
Uh-huh.
I have a term policy that goes out almost, it's into my early to mid 70s. So I probably won't do anything past that. But it's there for now. So, and protecting some of my future earnings during that period of time. I think that with children, it's very important. One thing also that people don't think about often is the stay-at-home spouse. And ensure, say you have a primary breadwinner and then a stay-at-home spouse that provides all of the child care at home and so forth. If you lose that stay-at-home spouse, you're going to have additional costs. You're going to have child care costs. You're going to have all types of things. You're not necessarily giving up a future stream of income, but you're incurring a future stream of expenses that you're going to need in the form of care for your children.
Which you're not accounting for.
Correct. So it's important that stay-at-home spouse also have insurance in play.
Yeah, I think that's something that a lot of people would think that they can save some money on right there, and that's you want to save money there. Yeah,
right. They say I only need it for the working spouse.
It may not be the same dollar amount.
Yeah,
but it's probably something that you should have.
Yeah. So let's kind of get into who needs life insurance. You said stay-at-home spouses. Anyone that needs that peace of mind. If you will sleep better at night, knowing that you have that policy in place and knowing that your loved ones will be protected should something happen to you, then you really ought to be pursuing life insurance, the right kind of life insurance for your needs.
Well, it's pretty much anybody that's not a lottery winner or trust fund baby.
Which is many of us.
Yeah.
A lot of us fall
Most
into
of
that
us fall
category.
into that broad category. So
Yeah.
Unfortunately,
if you're a Powerball winner, you may not need life insurance. If you are a trust fund baby, then you may not need life insurance. So,
The rest of us probably should consider it.
correct.
Again, parents with minor children, Adrian and I fit this category really well. People just like us, they need some life insurance coverage.
What we notice more often than not is that particularly young people, and when I say young, probably anybody under 40, I find more often than not is probably underinsured from a death benefit perspective. And it's, when I work with a new client that may be closer to my age, often, there may not, we may conclude that there is no need for life insurance. They're already retired. They're, everything is set up. They don't really have a whole lot of debt. They don't have any child or grandchild obligations. So there may not be need for life insurance. But younger people, it's something that should be done very strategically, in my opinion.
Yeah. Some other people that need to consider life insurance, adults who own property together, whether they have children or not. And then young adults who want to lock in low rates. You kind of mentioned briefly, Dad, that the older you get, the more expensive insurance can become.
Well, the insurance companies, all of these policies are written with something called a cost of insurance. That's 1 year at a time. So imagine a timeline from age 30 to 60. So a 30-year term policy. The premium's going to be level during that period of time, but then the insurance company has calculated a cost of insurance. That cost of insurance for year 30, and then 31, then 32. Well, that's pretty level. It's not moving up greatly at that point. But when you start getting to age 55 and 56, the chances of death are starting to increase more significantly, and they certainly are much higher than they are at age 30. So what happens is that line is not, you used to teach math.
It's not a linear.
It's not linear. It's not linear. Is that parabolic? Is that what it
exponential function?
Oh, it is. Well, yeah, it's almost, yeah. And so it starts to increase very, very rapidly. And so that's where, it becomes strategic to sit down with your financial planner and really think about what you need and how much life insurance, because often you need more death protection from ages 25 to 50, but you may need some protection beyond that. So it may even make sense to have, let's say you want to do $2 million of life insurance total of term protection. You might do $1.2 million for 20 years and then do $800,000 for 30 years. So you have more weighted on the front end, so that you do so you have $2 million of protection for 20 years, and then you have $800,000 protection for that last 10 years. So because you factored in your children will be grown, you maybe have a plan to pay off your mortgage, all those sorts of things. Another thing that we need to factor in is how much debt you have. So if you're living in a $300,000 house, that's one thing. If you're living in a $1.3 million house, that may be another, especially if it's financed. So we may want to factor in having protection there.
So obviously there are a lot of variables here to the equation, staying on the math theme.
Correct.
So that's where we can help kind of sift through all of those different variables to figure out the exact course of action for your particular needs.
Another thing that people often fall prey to is that you have many people out in the world selling life insurance. Often they have one product, one company that they represent and they sell. They can't shop it. We have the opportunity working through an insurance broker where we have access to over 30 insurance companies, and we can truly shop among the best deals for the different companies. And that becomes a big competitive advantage. So it becomes important to shop it around.
Some companies are charging a lot more for the same amount.
Especially term insurance is basically a commodity. You're dealing in U.S. dollars. You're either dead or you're not. The premium either was paid or it's not. It's very simple. So it's all about price.
Yep.
So anyway, it's also, sometimes you also, one other factor before we get ready to sign off is insurability can be an issue. And having access to multiple companies, we've run across cases where someone has a chronic illness that may be unique. And it could be diabetes, it could be some sort of heart condition, it could be any number of things. Certain carriers are, I wouldn't say they're eager to write those policies, they're more receptive, they're more comfortable underwriting policies and with certain types of issues. So we want to go and present an application to a carrier that's more willing to deal with diabetes patients or heart disease patients or patients that have had cancer in the leg. So that becomes an advantage as well.
So like I said, complicated world of insurance.
Well,
our job is to make it a little bit less complicated.
Yeah. And that's something that I think we've really, at least myself, I've seen over the last several months. Just the lack of education that a lot of people do have. They don't realize how little their death benefit actually is.
Correct.
How that's only going to cover their funeral, and they don't have anything extra, and how detrimental that would be to the surviving spouse.
Right.
Yeah.
Yeah, that's so true. So anyway, we'd be glad to help you if you have any questions or need help with life insurance or any other financial matters. And how can they reach us, Alison?
You can email us info@eaterfw.com. That's ITER.
Yep. And if you want to call,
my cell phone number is 205-504-9868.
All right. Adrian?
813-385-2804.
And mine is 205-613-4994. So, Jack, Alison, or Adrian at eaterfw.com.
All right, guys. Sounds good. So thank you for all joining us today. It's a pleasure to see all of your smiling faces. And thank you for listening today. Please like, follow, and share this podcast with your friends. Until next time, I'm Wendy McConnell.
Thank you for listening to the BAMCAM podcast with Jack Burnette and Alison Castellano from Eater Financial Wellness, a financial advisory practice at RFG Advisory. To get in touch with us, visit today's show notes or go to our website at www.eaterfinancialwellness.com. That's ITER financialwellness.com. And please click the follow button to be notified when new episodes become available.
Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Information here may be provided in part by third-party sources. These sources are generally deemed to be reliable. However, neither our guests nor RFG Advisory guarantee the accuracy of third-party sources. The views expressed here are those of our guest. They do not necessarily represent those of RFG Advisory, its employees, or its clients. This commentary should not be regarded as a description of advisory services provided by RFG Advisory or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, LLC, RFG Advisory or RFG, a registered investment advisor. Private Client Services and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place. RFG Advisory is an SEC-registered investment advisor. SEC registration does not constitute an endorsement of RFG by the Commission, nor does it indicate that RFG or any associated investment advisory representative has attained a particular level of skill or ability.